Imagine you're pushed out of a plane. You're plummeting towards the ground, but no problem, you have a parachute. Except you pull it. You look up at the canopy, and it's got a giant hole in it. Or imagine you're driving on a dark road at night. You realize at some point you must have driven over a nail because you're losing tire pressure. You think, no problem, I've got a spare, except you go to check, and the spare has a nail in it too. This is exactly the kind of oh no, followed by oh no situation that some homeowners are finding themselves in as they realize two things. One, that their mortgage payments have gotten too expensive. And two, that they can't refinance because the value of their home has dropped. Their parachute has a hole, their spare tire has deflated, their safety net doesn't have enough give. This is especially bad in the Toronto area, but it's a phenomenon that applies countrywide, where the homeowners who are most squeezed by higher interest rates just can't get the break they need from the banks. This is mortgage prison, and I can explain how it works. You don't need me to tell you how much more expensive everything is. Gas is up, and because gas is up, the price to ship everything is up. And speaking of everything, pandemic prices never really dropped back down to pre-pandemic levels, did they? But for homeowners, one of the biggest pain points can be interest rates. Remember those pandemic lows? Everyone was locked down, but the Bank of Canada was trying to stimulate spending by lowering interest rates. The key policy rate, almost 0%, just a quarter point.
It's by far the lowest that they ever went. It was an indicator as to how precarious the state of the Canadian economy was.
It was almost free money in a sense.
And a policy rate that low meant you could get a mortgage from a commercial bank at 1.5%. So lots of people saw that as a steal, and they locked in at those low rates for 5-year terms. Well, welcome to 5 years later. Sure, today, interest rates are nowhere near historic highs, but they're higher than they were during the pandemic. That means a 1.5%, 2% interest rate is more like 4% today, which really adds up. Let's say you have a $400,000 mortgage, enjoying that 1.5% rate over 20 years. That's a monthly payment of just over $1,900 a month. And by the end of your 5-year term, congratulations, you've knocked around $90,000 off your total loan. But 5 years later, yes, you're happy to have a smaller mortgage, but the higher rate is brutal. If you stay on track with your master plan, and now you have 15 years left on your mortgage, you're facing an increase of more than $350 a month just to stay in the home you already live in. But you can't afford that extra $350 a month because you're already stretched by the price of everything else. So instead of simply renewing your mortgage for another 5 years at this higher rate, you try to refinance.
The difference between a renewal and a refinance really boils down to whether a homeowner is withdrawing equity from a home or looking to rewrite the mortgage.
Refinancing would ask whether you qualify for a new mortgage. You could take out a brand new loan, different amortization, maybe extending your amortization.
So what most people do in this situation is figure out what they have control over. You can't control the size of the mortgage. You're paying as much as you can. You can't control the interest rate. That's set by God. I mean, the big banks. But you can control the amortization period. If everything was going according to plan, we'd have 15 years left on our loan. But things most certainly are not going according to plan. So what if we stretch this back out to 20 years? The longer the loan, the more time we have to pay off our debt, so our monthly payments drop accordingly. And through the magic of refinancing, this now actually works out to paying less every month on our mortgage because we've stretched it out so much. And this is pretty common amongst people who refinance. According to the Bank of Canada's latest financial stability report, among people who've refinanced in the last few years, about 70% extended their amortization by an average of 6 years. Big banks like this approach because, long run, borrowers pay more interest on longer loans than shorter ones. So refinancing by stretching out the loan period. Borrowers get easier payments, banks make more money, it's win-win. Except, what if the bank says no? Why would the bank say no? When people who rent look at people who own, I think they often see the home equity that the owner has as wealth. But for the homeowner who may be struggling with this massive loan that they have to pay back, their home isn't just wealth, it's what gives them options when things go wrong.
Even if you don't want to sell your home, you could go to a bank and say, listen, I've got some good wealth here. Maybe I can borrow against that wealth. So beyond the fact that you might already have a mortgage, bank might be willing to extend you a line of credit or other products.
Remember how refinancing a mortgage compared to simply renewing your mortgage at a new interest rate is really effectively negotiating a whole new loan. And if you think about the way banks approve mortgages in the first place, they ask all kinds of questions, right? Who are you? What do you do for work? How much do you make? And what's the value of the home you're purchasing? That's useful to know because that's your collateral. If you can't pay your mortgage, the bank forecloses. You lose your home. So the bank, knowing what your home is worth, is willing to take a certain amount of risk. Based on all the numbers, including the value of your collateral, will lend you, say, up to a maximum of $400,000. So you can start to see the problem when home prices drop, as they have been, across the country as an average, by 20%, depending on how you crunch the numbers, in only a few years. It's just headline after headline. And lots of people who've tried to sell recently will tell you, just not selling at a loss is kind of a win.
If you're a seller and you don't have something that's amazing, it's tricky and you've got to be realistic.
So no easy autopilot profits to see here, folks. Here's the death spiral, though, as I've seen it described, where you're in a bind because what if the mortgage you were approved for during good times was really at the outer limits of what you could afford? You were already stretched, and then hard times hit. You go to your bank and say, help a guy out, except they look at your loan to value ratio, the size of your mortgage relative to the value of your home. An LTV of 75% is considered risky. You were already at almost 90%. And now with the value of your home dropping, you're at 100%. I'm simplifying here, but the point is, if your bank already saw you as high risk and your risk just increased because the value of your collateral decreased, then they may not want to play ball with you, either by allowing you to extract equity from your home or lengthening the term of your loan. It doesn't matter how creative you want to get.
It's higher risk for the lender to lend out money for a property that's simply not worth it.
According to the Bank of Canada, the pressure of this mortgage prison is greatest in major markets like Vancouver and Toronto. Nearly 1 in 10 mortgage holders in the Toronto area won't be able to refinance their loans or renew them with a new lender in 2027 if home prices remain at current depressed levels. And what's more, if home prices were to fall by another 10%, that share would rise modestly to about 7% nationally and 12% in the Toronto area. So here's the outlook, summed up in one graph. In its most recent forecast, the Bank of Canada figures around 12% of mortgages today whose 5-year terms are expiring in the next 12 months, they're about to face monthly payments that are 15% higher than what they've been paying. We call that pressure. The good news, all those mortgage holders who are facing renewals with shorter terms aren't nearly as affected. You see how small these two bars are? Because if you were only on a 3-year term or paying a free-flowing variable rate, you've already been paying higher interest rates anyway. You weren't paying pandemic low rates to begin with because you bought afterwards. And more good news, once we get into the second half of 2027, even for people with longer 5-year fixed terms, the price differential is still comparatively small because we're getting far enough into the future at this point that people, again, weren't paying pandemic low rates to begin with. So this big differential is the last wave of people sailing off the mortgage cliff. Those people who bought at historic low rates but are now up for renewal at meaningfully higher rates. Now, it's not all bad news. The vast majority of people will find ways to make it work. The Bank of Canada notes, overall, mortgage defaults are fairly low and stable. But that doesn't change the fact that if you find yourself in an unfortunate situation and just can't make the math work, you're stuck. in a very difficult place.